what is term insurance? Term stands for temporary. It's temporary insurance. So if you have a 10-year-old and you want to be covered until they're at least 18 years old, you're probably going to go with a 10-year term, right? If you had a 3-year-old and you want them to be till 18, you're probably going to go with a 15-year term. If you have a brand new baby and you want it to be covered till they're 20, you're probably going to go with the 20-year term. There's not a need for a 6-year term, 7-year term, 8-year term, 9-year term, 10-year term, 11-year term, 12-year term, 13-year term, 14. There's not a need for that typically. And the cost variance between like a 10 to 15 is not significant. So imagine if you had to create 50 different products or 30 different products versus 4 different products. The administrative cost, the policy, the filling out an application, underwriting, by the way, getting policies approved through, if I'm an insurance company, to get 15 different policies approved versus 4 different policies approved. It's just functionality wise. You know, how many black shirts do you have? 2, 3?
Yeah, about 5.
Do you have 20 black shirts? No. Why do you need that many? Right? Does that make sense? You probably typically have 3, 4 white dress shirts, 2, 3 black shirts, a couple blue shirts. Does that make sense? So you don't need all these policies. Now, AIG sells a product, and when we're doing these videos as well, some of this stuff may not be present at the time that somebody's watching it down the road. But AIG does sell a product that's an year-specific term after 15 years. They're the only carrier that I've seen that does it. So if a person had 17 years left on their mortgage, they could go through AIG and buy a 17-year term. But again, why not buy a 20-year term if the cost is a little bit different and now you have more time, and then it has living benefits and all these other reasons. Another reason for a year-specific term, let's say I'm sitting with somebody that bought a 30-year term, and now they're 7 years into it. So how many years do they have left? 23. If I go show them a 20-year term, I'm giving them 3 years less of protection. If I show them a 30-year term, it's going to be more now because they're getting an additional 7 years of protection. So if I wanted to compete with the number of years that they had left on that policy, I would have to go do a year-specific term to match the number of years they have left for the quote to be competitive. So I took 2 years of protection away from them or 3 years of protection away from them. So that's why these policies exist. But if you don't take the time to know what every carrier has, then you cannot provide a solution to different clients when you're in the field, because all you know is what one carrier has and you're going to try to sell them that versus saying, what is your need? Oh, that company's the best over there. So there's something that they look for. Is there an insurable need, insurable interest, right? If the guy that works at the Mexican restaurant across the street has a heart attack and passes away, does that affect you at all? No, it doesn't mean you won't feel bad for the guy and his family, God bless him, right? But you're not financially damaged by him. So if you don't have some kind of financial interest in that person, you typically cannot buy life insurance on them. So sometimes you'll have a client ask you, well, hey, if I want to change this, you know, can I, if I only go with a 20-year, but later I want more and I want a different term policy, can I change this one? It doesn't benefit you to change this one because there's no savings in this one. There is no savings. You would just start a new term. But if you wanted permanent, then yes, you would convert that term to a permanent policy. Whenever you convert a term policy to a permanent policy, you do not need to requalify. That's the benefit of conversion. Otherwise, it wouldn't be called conversion. It would be called apply, right? New application. If the term was a 30-year term, you can't convert it at 31 because it ended already. So you have the life of the term to convert it. And typically, there is a clause that says you can convert till the life of the policy or this age. So this is more of you're sitting down with somebody that has a term policy already and you're probably converting that, or you sold a 30-year term and year 3, 4, 5, 6, 7, the person's finances changed and now they want to make a portion of it permanent or the entire amount permanent. But if you sold a 30-year term and the person gets to this age where they cap out, you can do it for the life of the policy up to this age. Right? Now, hypothetically, let's say it was I'm 50 years old and I say, hey, you could do it for the life of the policy. It's a 30-year term, so it would cover me till 80 or the age of 70, which means, yes, it will cover me till 80 if I pass away, but I can only convert to permanent until the age of 70. After that, I lose my conversion privileges. Now, here's a creative a solution for somebody that's uninsurable but already was insured. They may have a term policy. Now something went wrong with them. You can't sell them a new term, but what you can do, even though you won't get paid on it, you can help convert that term into a permanent policy so they don't lose the term. Or at least educate them that that's an option for them. You're sitting with me, I've had a heart attack, I have a term policy. No term policies have savings. When I pay for car insurance, if I paid my payment for the month of August, I have insurance for the month of August. There is no savings, so if I cancel it in September, I do not get anything that I paid. So that in itself is how all term policies work. Now the second one is a 10-year term, 15-year term, 20-year term, 30-year term, 35-year term. There are companies that will create a 40-year term. We do not sell any of them, but you may run across it when you're in the field. If you have a need for insurance for the next 40 years, you maybe should have gotten a permanent policy because that's a very long time. The only reason somebody may sell a 40-year term is because they cannot sell a permanent policy. So there are companies that only sell term insurance. You may know their names, okay? But you will run across them. That's all they can sell. So it's a 40-year term product or a 30-year term product. Nothing wrong with a 30-year term. Nothing wrong with a 40-year term. But if I still have a need that long from into the future, you may want to consider permanent. And the only reason that maybe you're not is because you can't sell permanent. The longest one that we currently sell at the time of this video is AIG's product where they have a 35-year term. In regards to these, they're pretty simple. There's a death benefit, which means when you pass away, that money goes to the family. Some policies have living benefits, which means that you can touch the money while you're alive. Every policy I've seen in my career that's a term policy or a permanent policy has the terminal illness rider. A terminal illness is something where you go to a doctor and they tell you you have less than 12 months to live, less than 24 months to live. You have an illness that is going to cause and bring about your death. It is terminal. Some policies, you have to be within the 12-month time frame. Some policies, you have to be within 24 months time frame, which means if I have a cancer and it's terminal, but I'm going to live for the next 18 months, I cannot activate a terminal illness. It's a 12-month terminal illness because it's not time yet. So they won't pay me until I hit what? I only have 12 months to live now. So these are little added benefits when you have a terminal illness that's a 24-month terminal illness. So it's important for you to know this policy, is it a 12-month terminal illness or a 24-month terminal illness? Will it change what I sell? Probably not, but is it good for you to just know it? Yes. When you do this, you typically get around 80% of the face amount. You'll hear the acronym DB. Hey, what's the DB on that? That just stands for death benefit. So they'll typically say, hey, you have $1 million policy. We will pay you roughly 80% of this. We'll give you $800,000 tax-free. You no longer have life insurance. Here. That's terminal illness. If I have a term policy and I want to activate the terminal illness, they are saying, okay, you basically are accepting a paid up amount. So if I get 80% of my policy, I'm accepting $800,000 now. I do not get the $200,000 later. There is no more $1 million. I'm choosing the $800,000 now so I can use it to live, travel, spend time with my family, go seek alternative treatments that maybe the health insurance provider isn't going to pay for. So the policy's paid up. That $200,000 does not come to your family when you die. The insurance company, you chose to use it early, and the company says, no problem, we will pay you a reduced amount. So the benefit to the insurance company is they are basically saving paying out $200,000 of claim, but they're also cutting a check right now up front for $800,000. Anytime that life insurance death benefit is paid out or living benefits are paid out, it's always tax-free. The worst thing that the government can do is say, hey, I know you have cancer, but you just made $800,000, give me $240. The 12-month or the 24-month test means that if you went to the doctor and the doctor says, you have 18 months left to live, and you had a 24-month illness, terminal illness rider, because you're within less than 24 months, they're paying you $800,000 lump sum. They don't give you the payments over 12 months or 24 months. No, it's as long as you have less than that time to live. So you have a terminal illness. You have a chronic illness. Sometimes I'll hear people say you have a chronic illness. Chronic illness, not chronicle. Okay? So what is a chronic illness? It's something that stops you from doing 2 out of 6 activities of daily living. They call these ADLs, activities of daily living. The first one, and I just think about what I do when I get up. The first thing I do is I walk to the bathroom. So that's called transferring, moving, right? 2, I use the restroom. So this is called toileting, however you want to use it. 3, shower. I take a shower, bathe. 4, I get dressed. 5, at some point in the morning or afternoon, I'm going to eat something. I can feed myself. And 6, I can control when I use the restroom again. If for any reason I cannot do 2 of these 6, I have a 90-day exclusion. So day 91, they would start to pay me out a benefit if this happened. So I have to not be able to perform 2 out of 6 activities of daily living for at least 90 days. Day 91, they're going to want a letter from a doctor, probably a second one, saying this condition still exists. Then from there, they'll start to pay you out a monthly benefit. Every carrier is different. Some will pay monthly, some will pay annually. It's good for you to know how those pay out. If you want to be able to show your clients the potential of what they could receive if they were to have one of these illnesses, in the illustration, you can enter several different ages and then run the illustration, and it will show you at this age, this is how much you would get if you had a chronic illness or a critical illness or a critical injury. So don't use percentages. Oh, they'll give you around half. That is not accurate. Instead, illustrate so you give them exact numbers, and then you have an illustration to back it up if they ever say, hey, you told me this. No, here's the illustration. So some people, this is how they sell this. This is a mistake. Oh, your policy has disability, you know, da-da-da-da-da-da-da. Well, now I get disabled at work and I break an arm, so I can't do my job. And I call you and I say, hey, I need to activate my disability policy. This is not a disability policy. This is completely different than a disability policy. If I broke my arm and I'm a dentist, I may not be able to do dental work. That doesn't mean I cannot move. That does not mean I can't use a restroom. I may have to use my other hand. It may be weird, but I can still use the restroom. I can shower. It may take me longer. I can get dressed. It may take me longer, but I can still function. I break both my hands because I go snowboarding. Okay, I can't do any of these. Will this start to pay me after 90 days if I can't do these? Because I'm not functional to be able to do these. But if you break your arm or your leg, anybody broken something before? How long do you typically have to be in a cast? 6 to 8 weeks.
6 to 8 weeks.
Okay. Now, so that means, if I'm at 8 weeks, I'm still not at 90 days because that's 12 weeks. So something to consider, it's not a disability policy. It will not cover you in the form of a disability. You need short-term disability to do that, and you could typically get that through your employer. This covers you if something very serious happens to you. It's some kind of illness, and again, it's a 90-day exclusion. If anything happened to you, you'd probably go to a doctor, right? And so now you're at the doctor, and it's going to show, hey, JP came to the doctor on August 1st. You have something that's stopping you from doing this, okay? At that moment, you're probably going to notify, if it's something serious, you're probably going to notify your insurance company. Hey, what do I need to do? You know, this could last longer than 90 days. Is there anything you need from me right now? Hey, you know what? He will send you the paperwork. If in 60 days or 45 days from now, our processing time takes X amount of time, you know, get back to us. If it gets worse, get back to us if, you know, you hit this mark. At that point, then day 90 comes. September 1st is 30 days, October 1st, November 1st, right? So you've now had it for August, September, October. So November 1st now is that day mark. You have the doctor record that you went on August 1st. You're now 90 days into it. You go back to the doctor. The doctor says, hey, you still have this condition. You now provide that information to the insurance company. There is a record of showing that you've had that 90-day you've had that situation for 90 days. If I have a $500,000 death benefit and I start getting $5,000, it doesn't mean that I have $495 next month. It's a formula that the carrier has, and it's going to be a reduced paid out amount that they're already calculating since you're using it sooner. So it's not $500,000 anymore. It's now less, and it's a percentage of that. The best thing to do is, again, run an illustration to see what that would be for that client. If I start getting $5,000 a month in this example, does my policy that's $500,000 get reduced proportionately to the $5,000? So I took one payment of $5,000. Now if I died next month, my family gets $495? No. If you're using this sooner than expected, it's not $500,000 anymore. It's now a lesser amount, and then if you're getting a monthly payout, it's a percentage of the lesser amount. The longer you've had the policy, the larger that percentage will be. The shorter you've had the policy, the shorter that will be. But clients will ask you, is there an exclusion period? Now, this is a 90-day exclusion period to be able to use the benefit. I may have had to have the policy by September 1st before I can even start a 90-day timeline. So if I bought it today and then tomorrow I had a chronic illness, they may say, hey, you're within that 30-day window of a new policy. This benefit is not immediate, it's after 30 days. So you want to know the details of what you're selling. Again, some of the benefits are immediate. Okay? Some of the benefits on here also have a cap. So if you ever run an illustration, like with National Life Group, and you're looking at critical illness, the way National Life Group illustrates is the chronic illness is a monthly payout. And if you put age 40, 45, 55, 65, it'll show you what my monthly payout would be at those ages. The way the next one illustrates, which is critical illness that we'll talk about in a second, that is lump sum. And you'll see maybe 0 for minor, 100,000 for moderate, 300,000 for severe, and $1 million for life-threatening. Now, I may have a $2 million policy, but you may see that the life-threatening is $1 million, whether I'm 30, 40, 50, or 60. Why? Because there's a maximum that critical illness will pay out. It is also not the entire amount of the policy. This is, where do you think I learned this? Do you think there was a class like this do you think I learned this from a class? I learned this from reading illustrations because I was curious to know, is this good for people? What are the details that I don't know? That's why if you're a curious person, you're typically a great producer. Would you want you as an agent? Life is really simple. Would you want you as an upline? Next one is critical illness. There are companies that have different definitions of what a critical illness is. Most of them are going to cover cancer, heart attack, stroke, other things like maybe ALS, and other conditions. You should pull up the critical illness brochure of whatever you're selling and look at what does it cover. Lastly, number 4 is critical injury. This could be severe burns, traumatic brain injury, loss of a limb. Now, some companies will say we have 4 living benefits: terminal illness, chronic illness, critical injury. Some will say we have only 3: terminal illness, chronic illness, and critical illness. Some may say we only have terminal illness. Some may say we have terminal illness and chronic illness. Some may say we have terminal illness and critical illness. You follow?
Yeah.
Which means, does every policy come with all 4? No. Can it have terminal illness is the most common, you'll see it on almost all. But could it be terminal with this? Yes. Could it be terminal with this? Yes. Could it be terminal with this? Yes. Could it be terminal with this and this? Yes. Now, some will also say we don't have 4 benefits because our critical illness also covers these 4 here. So then you'll say, oh, this one doesn't come with critical injury because they only have critical illness. But you don't know that their critical illness also covers critical injury conditions. Make sense?
Yeah.
So don't be so quick to say, oh, this one's better over here. Look at what the chronic illness covers, critical illness covers, critical injury covers, terminal illness if it's 12 or 24 months. Look at these things. Do you think that I remember all of these things on every single policy? I have no idea. If you ask me right now, what do they cover? I'd probably give you a few, but I'm probably going to miss some too. But here's what I know. I know that there's 4, and I know they cover different things, so I can always go look at what this covers and what this one covers and then compare the two. Right. So the goal is not for you to remember all these things. The goal is for you to be able to say, I know there's 4. Let me see which are the 4. Okay, this one only has 3. Let me see what it covers. The goal is for you not to have to remember. It's to understand. If you are trying to remember all this, you're going to forget it. But if you understand the concept of this, then you can always go do the research to learn the details of what you're looking for. So these are living benefits. Living benefits will reduce the amount of the policy. Now, somebody will say, if I have a policy like this, and I have a chronic illness, and I have a situation where I start to get payments, but then I get better, do I still have life insurance? Yes, you just have less life insurance. Will it reduce my life insurance my family gets? Yes. Now some will say, hey, if it comes with this, but I decide I don't want to touch it, do I have to take the living benefits? No, you do not. Do I have to take terminal illness? No, you could leave the full $1 million for your family. You can choose to talk to the company and say, hey, I just want $500,000 now, and then when I pass away, give the $300,000 to my family. The insurance company is not going to pay you interest on that extra $300,000. So if that was my client, I would say, why don't we take the full $800,000 now, and whatever you're not going to end up needing when you pass, let's put that extra into an index annuity where it can earn interest for you. And then when you pass away, that's going to go to your family instead of letting the insurance company keep that $300,000 and it's not earning interest for you, right? Now maybe that client doesn't need all of that to begin with. So maybe it's better if they only take a portion to cover their needs and they'll get a larger death benefit. So what if the company says, hey, well, we'll give you $100 now and we'll just reduce your insurance benefit by a smaller percentage than getting all of it now. Well, then maybe I'm only going to take that portion. Again, look at scenarios. I had a client that had a critical illness. They beat it. It was cancer. They beat cancer. She then wanted to take a payout afterwards. She was cancer-free. I didn't know if the company was going to pay that because I didn't know, do you have to currently have that illness in order to take that distribution? And National Life Group said, no, not a problem. You've had it. You didn't activate it then. You could still activate it now. I said, okay. So then she says, what will they give me? They had $250,000 of life insurance. They offered her roughly $83,000. She says, what if I don't want the full $83,000? They said, well, we'll give you, tell us what you want. What if I wanted half of that? Okay, well then you'll still have $125,000 of life insurance and we'll pay you the $40,000. What if I only wanted $20,000? Okay, well then they'll give you this much life insurance still and you'll get the $20,000. So you don't have to take the entire amount and they will be willing to work with you, okay? So you can customize that to your client's needs. Sale opportunity. Most people that have a life insurance policy, they do not typically have all the living benefits. So I'll ask a client a question. Do you have the old type of life insurance or the new type of life insurance? That's an alternative choice sales question. Do you have the old type of life insurance or do you have the new type of life insurance? Do most people know? No. So now I'm basically asking them a question that's forcing them to ask me a question back. When you ask me a question back, it tells me you need what I have, you don't know what you have, and there's an opportunity to educate you. So I'm, without them being like really aware, I'm creating a condition for them to see that they have a need for more education. That's what great questions do. So do you have the old type of life insurance or the new type? What's the difference, right? The old type only covers you when you pass away. The new type can give you a payment while you're alive if you were to get sick. Be prepared for what they're going to say. I don't know. I think that's important, don't you? Great. When can we call your carrier to find out? Now, if I'm in the early phase of an appointment and it's before these companies close, which is typically around 5 o'clock Eastern time or 6 o'clock Eastern time, I may right then and there say, hey, are you okay if we call real quick and just find out what you have? When you ask a question, depending on how you ask the question, affects the answer that you get. If the client believes that this is going to be a stressful, long process, they're probably going to say what? Not right now. Let's just schedule it. But if I ask a question in a nonchalant form, and it's real simple, and it's real quick, and it's simple, and it's easy, they're probably, sure, we could do that right now, right? So if you phrase a question like this, can we call your insurance carrier and ask them all the details on your policy and find out, what exactly you have and don't have? Then the client's going to be like, yeah, we can do that, but not right now. Let's do that a different day. But if I said, hey, are you okay if we call real quick and just see what it is while we're together? Do you see how simple of a nonchalant that is? That's part of you understanding the mechanisms of people, the psychology of people. People are not responding to what you say, they're responding to how you say it and your body language. When I'm with a client, I want to be very comfortable because then they're going to feel comfortable. So I want to find out, do you have any of these? Second sales opportunity. Life insurance costs, do you think they've gone down over time or up over time? Now, I'm not saying if you have a policy yourself, does your cost go up over time or down over time? That's not what I'm asking. I'm asking the overall cost of life insurance. Do you think it's gone up over time and cost of insurance has increased, or do you think cost of insurance has decreased? Life insurance cost has decreased over time. If I know you're a 20-year-old and life expectancy is 35, you only have 15 more years to live, so I have to charge you enough to be able to have the money to pay your family. But if all of a sudden now I know you're living till 78 or 79 or 80, I can charge you less because I'm going to collect premiums for more time. The chances of that term policy paying out are much slimmer for a 30-year-old that gets to 60. Why is this important? When you're with a client, you may ask, are you paying the old cost of life insurance or the new cost of life insurance? Well, when did it change? They may ask. It was around 2020 or so that a lot of these companies started incorporating new costs of insurance. So if somebody bought a policy that's a little bit older than that, they're probably paying the higher cost of life insurance versus the lower cost of life insurance. When that happened, I had a term policy that I had purchased. It was a $2 million term for 30 years, and I had it like 26 years left. And I was able to not change it, but get a new policy for 35 years for the same amount of coverage, but with living benefits for almost the exact same. So if somebody has an older term, they don't have this, plus they're paying those costs, you may want to do a term comparison. The concept of term, keyword is what? Temporary. So when you're younger, these are your debt, your responsibilities, these are your savings, and your assets. So when you're starting off in life and you have a student loan, you have a mortgage, you have young children, your debt or responsibility is high. Your savings, you just started working. Maybe you just got your first job. Maybe you're at a lower hourly wage or lower salary. So your savings, your assets, your income is not that high. Over time, naturally, savings should what? Should grow. And over time, your debt and responsibilities should what? The mortgage gets what? Paid off. The kids grow up, so the responsibility goes down. And you're supposed to get to this point here where your assets and savings and money and financial situation is enough to cover your what? Responsibilities. And when that happens, you reach this place of you're considered self-insured. So the concept is that if you were 30 years old and you bought a 30-year term, that by the time you're 60, you've paid your mortgage off, your kids are adults, you've saved enough money to where you don't need life insurance anymore. There's nothing wrong with this. This is how life insurance should work. It's called the law of decreasing responsibility. The challenge here, guys, is most people, does this always happen? What if this goes like this? And all of a sudden somebody gets sick and they lose their house and then they have to rent for a little bit and then they buy another house. Their debt just went up again. What if their savings is going up and then somebody, loses a job and they have to live on this and their savings goes back down? And then a parent passed away or a child passed away or something happened. And all of a sudden, Their savings is gone. Now they still have a high debtor responsibility and they don't have enough savings or assets to cover it. So now they still need insurance. The challenge now is I'm not 30 anymore. I'm now 52. And I have high cholesterol. And maybe I had something happen where I have an accident, so I'm taking some pain pills because I was in a car accident. Do you think I'm still going to get a preferred rating? No. So now this person has to buy another insurance policy. The cost of insurance is going to be much higher for this person. So not always does it work out where the person becomes self-insured in the future, guys. There are people or companies that only sell term life insurance again. And their concept is buy term and invest the rest. Buy term and invest the rest. And what they're saying is that by the time you invest the rest and you get to this point, you'll be self-insured. Okay, no problem. It's a concept. It may work. But there's a challenge when you're serving a middle market or a lower income market. Don't get confused with income, where I say lower income market, with like where I'm saying somebody's low class. I'm talking about income, not class. I'm not putting anybody down. It's a lower income market. They're struggling a little bit financially. So the challenge here, what if I can only put away $25 a month? What if I can only put away $50 a month? Do you really think that by 30 years from now, I'm going to have all my assets and my assets are going to be significant? So the challenge is that you buy a term policy and you invest the rest, but you're not investing enough to be self-insured. So it's a failed philosophy unless the investing the difference is going to self-insure you in the future. There are companies where they'll say, buy term and invest the rest. What they're investing in is typically mutual funds. We'll talk about what mutual funds are, but they're investments in the stock market. You have to have a separate license to sell this. And this license is through the SEC, stands for Securities Exchange Commission. And they call this a series license. There are different licenses to sell different financial products. So if you sit with somebody that sells stock, they're going to have a Series 7. If you sit with somebody that sells mutual funds, they're going to have a Series 6. If you sit with somebody that sells active management investments, they're going to have a different license. Now, these are the product licenses. They also have to get an ethics license to sell these, and that's called a Series 63. One, make sure you know the product you're selling. Two, make sure you know all the laws around selling it. So if you are an agent with most companies, unless you're a stockbroker, like where you go work at Morgan Stanley or Merrill Lynch or one of these firms, if you're just a mutual fund agent like at a bank, sometimes bankers will have a Series 7. But most agents that are independent contractors that work with other companies that are FMOs like ours, FMO stands for Financial Marketing Organization, they typically have a Series 6 and 63. The challenge with this is if you're dealing with a new agent that's in the industry, they typically don't have this license. So now you sat with this family, you sell them a term policy, you never do invest the rest because you don't have the license to sell that product. So now the family basically, the responsibilities are maybe decreasing, but they never have any assets because nobody helped them invest the rest. When we get to the part on mutual funds, I'm going to show you how mutual funds pay. And we'll go more into advanced detail on it. But most of these products pay around 5.75% to an agent. We'll talk about that. So if I have a $50 a month savings policy, what is 50 times 5.75%? 2.875. That means that the commission on this, every time that client puts in $50, I'm going to make $2.87. Okay? If I'm at a 50% contract, that means I'm going to make $1.43. I want to ask you, as an agent yourself, do you think you really want to go run a 2-hour appointment to go sit with the family? Now, and I'm not saying you shouldn't. I'm not saying it's not worth it. I'm not saying that the commission should determine whether you run it or not. I'm saying let's consider most people are normal people. Unfortunately, self-interest in this, there's not a lot of self-interest in here, and the amount of sacrifice or time may not be worth the return. So a lot of people are not going to say, let me go sit with this client so I can make $1.43 every single month. And in the next 20 years, I'll make $300. So guess what? They never go back and sit with the family. So now the family only has term insurance. So buy term invested difference is not a bad philosophy if it's done correctly. Okay? I tell people to do it at times, and we'll determine why when we're talking about suitability of product. We'll get there in a minute. But if it's not done right, it's just really damaging to a family. There are companies that only sell term. We sell term too. So I'll ask these agents and I'll say, hey, if you could sell term, I know you only want to sell term. If you could sell term, but you could sell 20, 30 different companies or 10, 15 different companies so you can get a better term for your your clients, are you open to that? No, we have the best term in the world. The moment somebody tells you that we have the best term in the world and they're not, that's impossible. Because you can't mathematically say you are the absolute best company in this world for every single client, every scenario. And if there's a company and it only sells one product, those are called captive companies. Well, the problem is, what if your client gets denied? Well, now you can't go offer anything else. What if you're selling with a client that's 80 and there's no term policy that's available for an 80-year-old, but they want a final expense policy that's going to cover their funeral? You can't help that person. What if you're sitting with a client, and they have diabetes and that company doesn't want it, but this other company will take that client? Well, if you are captive, you can't sell that other company's product. So unless you can offer majority of the products through majority of the carriers, you're never really truly doing what's right for people. There are some policies that are a decreasing term. A decreasing term, I've never sold one because the amount of insurance every year, it goes down. But guess what happens to the payment? It stays the same. So why would I buy something and pay the same payment if I'm having less every year? It's not good for the client. It's only good for who? The insurance company. It's not even good for the agent. It's just good for the company. There are products that are called increasing terms. An increasing term, the cost of insurance does what? Now, sometimes the coverage doesn't increase either, so just the cost is going up. There are some times that you can have an increasing term where, yes, it will add a little bit more life insurance to your policy over time. But if that was the amount of insurance that you needed, you should have got it in the beginning. So we sell level term policies for the time a person needs it. We don't sell increasing term or decreasing term where the payment's going to change for that client.